Today I'm sharing a hyper growth stock that is down over 55% from recent highs and down 34% since the start of this year. Could this be a rare opportunity in a millionaire maker stock? Now, as always, do your own research. I'm just here to help get you started, and none of this is financial advice. Let's do it. What's going on, everybody? My name is Matthew, and today we are talking all things Teladoc, ticker TDOC. Here's the format for today. First, we're going to do a refresher and overview of the business. Second, what people are completely missing about this company in my personal opinion. Third, the massive opportunity here and big news for the stock. And finally, fourth, the risks involved and the valuation. Now, right up front, I do own shares of the stock and I may plan on buying more soon. If you're interested in real-time research and buys and sells, you can check out Investor Community down below in the description. But enough of that, let's get right into it. So about the business, Teladoc is a telemedicine company that can help you with general medical, Primary 360, which is their primary care service, mental health, specialist and expert opinions, and of course, wellness care. And this is all from the comfort of your home through virtual meetings. And right now, Teladoc is arguably the leader in this fast-growing telemedicine space. And I know your first thought, before you start thinking, oh, telemedicine is just going to die down, it's not staying, it was only a thing because of lockdowns, I have many facts and points of research to potentially prove you otherwise. What you must understand is that their business is not to get individuals like you and me to sign up for their service and do virtual visits. Actually, their clients are larger organizations, healthcare providers, and insurance providers. So do not think about this as like a Netflix where you sign up and subscribe because you need shows, or in this case, because you need a doctor's visit. Instead, understand that their clients are giant organizations and healthcare providers that then extend Teladoc's benefits to their employees or members. And that is when it reaches you and me. So it's no secret that the stock is down huge and short-term sentiment is very negative. And that's partially driven by the fact that the narrative is, oh, it's a lockdown stock, it's a Rona stock. Once the world opens up, no one's going to be making visits anymore. It's also because they have had a recent track record of consistently missing earnings, and that has set them up for failure. Well, I'm here to talk about why I'm actually still a bit bullish and, again, what people are misconceiving. So the first thing that's quite impressive to me is actually their growth and how they've grown, and I think it might surprise you as well. So this is their guidance from their most recent earnings report, and keep in mind that these year-over-year metrics, or where you see YOY, these are numbers being compared to 2020, when they were producing some of their best numbers in company history, because we were literally in a global lockdown, the perfect environment for Teladoc. And now, despite going against those very difficult comps, they're expected to grow revenues by over 83% this year in 2021 and grow adjusted EBITDA by over 100%. And this is also with the number of paid members staying nearly flat and total visits growing far slower than revenue, which brings us to one of the biggest, again, I've said it so many times, but misconceptions with Teladoc. This company actually has a decently strong moat. The common bearish argument for this stock is that anyone can visit a doctor through Zoom or one of their many other competitors, or that once the world goes back to normal, there's no use for this anymore. Well, if their revenue was entirely dependent on actual visits, that would be partially true. Revenue from actual visits stayed flat year over year, but access fee revenue jumped 138%, bringing total revenue up 109% year over year. So visit fee revenue only accounts for about 11 to 12% of their total revenue. Their business model is not entirely dependent on their visits. And again, that's because they're making deals with these large organizations and not individual clients. Other misconceptions is that membership growth is stalling, only increasing by about 2 million in the past year and barely increasing at all if you count the 1.5 temporary US paid members in 2020. And in the next segment, I'm going to explain why that number is about to explode in 2022. But to finish this segment off, their moat is their network and relationships with all of their existing massive clients, and not to mention all of the data they have collected. For example, they now have 1.72 billion with a B data points from Livongo alone. That data is only going to help make their business and products more efficient, specialized, accurate, and more. All right, now on to some massive news for the company and the incredible opportunity at hand. Just recently, a CVS Health company, Aetna, I think is how you say that, announced Aetna Virtual Primary Care. The executive VP of CVS and president of Aetna, said it's a first of its kind healthcare solution that provides a simple, affordable, and convenient way for members to receive primary care from virtually anywhere. And all the benefits of this new feature are listed in this screenshot below. And now this doesn't look too good for Teladoc, right? Another competitor as big as Aetna. I mean, they have nationwide 39 million people depending on them for decisions on their healthcare and healthcare spending. Psych! Teladoc's new Primary 360 is the one partnering with Aetna to help them roll out their nationwide primary care in 2022. Now, these new membership numbers haven't hit Teladoc's earnings report yet because this deal is, again, being executed next year. But this is obviously a massive win for Teladoc and their new piloting Primary 360. So to clarify, there is no new competitor. Aetna, who helps 39 million people nationwide, is partnering with Teladoc and their new service Primary 360 to roll out nationwide primary care from virtually anywhere. Now, zooming out a bit, according to Markets and Markets, the global telehealth market is expected to grow at 37% CAGR, or compound annual growth rate, and reach $191 billion by 2025. Teladoc is arguably the leader in the telemedicine space, and they're expected to generate over $2 billion in revenue by the end of this year. So if the TAM is $191 billion, their runway is absolutely enormous. If they can just capture 10% of that $191 billion market, they are nearly 10xing their revenue from today. And even higher estimates put the market opportunity in telemedicine at $250 billion, and this is from McKinsey. Now, as a reminder, yes, telehealth did spike up and come back down over the course of the past 2 years or so. However, it has stabilized at 38 times the typical telehealth volume from before the global lockdown. In other words, telehealth jumped several years into the future for the growth of the industry in a matter of a year. The telehealth volume today is 38 times the normal volume before global lockdowns, the illness, and everything like that, and it's steady here. From this same study, and for your continued research, these are the most common reasons people use telehealth. The most common reason being psychiatry. And yes, that is something that Teladoc does offer, and they also recently launched MyStrength in May of this year, a personalized, comprehensive mental health service. Now, with every investment, there are risks, or I guess what you could call cons, so we'll take a look at those as well as Teladoc's valuation. As we can see from this chart of their shares outstanding, there is a risk of dilution with Teladoc. Much of this recent jump is obviously from the Livongo deal, but TDoc is an acquisitive business, meaning it acquires many businesses and may continue to use stock as a way to make those deals happen. And generally speaking, more shares outstanding is not a good thing for shareholders because it devalues the shares you already own. Another risk is the high amount of stock-based compensation, which is kind of a sneaky expense because you can make it look a lot better than it really is through adjusted numbers. There's also a really high level of executive compensation, but investors expect stock-based compensation, hopefully kind of the executive greed, to stabilize in about 2022, but this is an area for further research for me. There's also the earnings misses, which we touched on earlier in this video, and finally, profitability. Profitability is probably one of the other biggest arguments against Teladoc because it's not quite clear their path to profitability or when they'll become profitable. But there is something called the Rule of 40, and this is the rule that the growth rate plus their profit margin should be greater than 40. It's primarily applied to SaaS and software companies, which Teladoc doesn't perfectly fit, but let's take a look anyways because it does give us some way to justify sacrificing profitability for continued revenue growth. So taking a look at their most recent quarters, we can actually start with Q4 of 2020 and look at their revenue growth and add their net income ratio, which has previously been negative. And then together, those gives us the Rule of 40. If it's over 40%, then it checks out. It passes the Rule of 40. So with revenue growth, for example, of Q4, we have 145% growth year over year, and we subtract a net income ratio or net income margin of a negative 102%. So 145 minus 102 is 42%. So that actually checks out on the Rule of 40 despite having such a negative net income margin. Then for Q1 of this year, they had 151% growth year over year, adding a negative 44% net income margin. That's 106%, well over the Rule of 40. You do the same thing for Q2, their most recent earnings, and you get 82, which is well over the Rule of 40 as well. And now Using their estimates and projections for Q3 and for the full year, we can guess that their revenue should be about 510 and 533 for the next 2 quarters of this year. And that would give us year-over-year revenue growth of 77 and 39%. So if we do 77 to get 40% at least, they would have to have a net income margin of negative 36%, which I think is very attainable. However, in Q4, they would need a net income margin of break even or slightly positive to meet that rule of 40 if their revenue is as projected. So when we base things off of the rule of 40, it almost looks like their lack of profitability has been justified by their growth, but then that starts to come into question in Q4 of this year. Now we get to talk about their valuation, which is the most important part probably of many investments. It's currently trading at the same price to sales ratio as before the Rona, the global crisis, all the lockdowns and everything. Same price to sales as November of 2019. Which I think should make anyone take a second look at this company right now. And if you want to factor in cash and debt and use the enterprise value, we can look at their next 12 months EV to sales, which takes your enterprise value and your projected revenue for the next 12 months. And that too is trading at pre-pandemic levels. And as you just saw, they are not very profitable right now, so it's not quite worth looking at their profitability metrics, as clearly their focus is on growth. So Teladoc has been a really rough ride for a lot of the investors for pretty much the entire year. It's been a roller coaster. It shot up at the beginning and came all the way back down here to the 130s. So I'm underwater on this position, but I'm considering adding more, as it's only about 4.5% of my portfolio. I could see it going to 5 or 6% as I continue to do more research and potentially gain more conviction. Definitely check out Hungry Bull down in the description below as well. It's an investing app to track stocks, listen to earnings calls, do all sorts of stuff, create watch lists. It's really, really great. Check it out, download it below. We have over 30,000 weekly users on there now. Check out the quote of the day. You might just learn something. Make sure to like and subscribe. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.